Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. This week turned out to be relatively quiet for the dollar. The dip at the end of last week was replaced by hovering near the bottom, i.e., around the 99 level on DXY, which corresponds to the lows of the last 3 years and slightly below the reversal area of the last 2 years. This situation suggests that we are only seeing a pause before a further downside, not a reversal. Since the beginning of April, an inverse correlation between the dollar dynamics and the value of promised tariffs has been evident. Rising trade barriers lead to a sharp sell-off in the U.S. currency. What is particularly disturbing is that both U.S. stocks and bonds fall during these periods, a phenomenon common in emerging markets but rare in developed markets and almost never occurring in America. This is an unambiguous signal from traders that trade wars are sharply curtailing the exorbitant privilege the U.S. has enjoyed for the past half-century. Nevertheless, the Fed appeared to stand up for the dollar on Wednesday. Powell warned in his latest speech that the current situation justifies keeping rates high and even hinted at the possibility of a rate hike. These comments have helped the dollar index stabilize, but there are no clear signs of a rebound yet. On the weekly charts, the RSI has reached oversold levels, which were last seen in August of last year and previously in early 2018. However, it took more than a month in the former case and about 4 months in the latter before a rebound occurred. U.S. stock indices have been under pressure, with the NASDAQ 100 losing about 6% over the week and the S&P 500 losing about 4.5%. While this is a wide range in normal times, the amplitude of the current swings is almost 3 times smaller than the previous week. Extreme fear continues to dominate the markets, but history shows that a return of the fear and greed index to double-digit territory encourages investors to go into buy on downturns mode, which maintains an upward bias even in the face of increased volatility and nervous trading patterns. The S&P 500 continues to clash with the downtrend line formed over the past 2 months, but a strong bounce last week prevented a slide below the 200-week moving average, the most important support of the past 14 years. Previously, an approach or breach of this line has been accompanied by the launch of the Fed's emergency liquidity injection measures, or a change in its policy. Additionally, on the daily charts, the RSI index has started to bounce off the lowest values seen since March 2020. Gold delved deeper into the territory of all-time highs during the week, reaching a local top above $3,350 per troy ounce on the spot market, representing a more than 4% gain from the start of the week. The price later retreated to the $3,300 area. Gold has been on the offensive since touching the 50-day moving average early last week. We view the latest rally as the completion of the correction from the late December spike. The upside potential, in our opinion, allows us to expect quotes above $3,500. The price is currently above its 200-week moving average by 60%. By comparison, in 2020, with a gap of just over 50%, the price stalled, then corrected, and went sideways for 2 years. The last time a higher gap up was recorded was in 2011 at around 70%, which was accompanied by a prolonged bear market. In the current situation, the 70% breakaway can be achieved when the $3,540 level is reached. Over the past 7 days, the cryptocurrency market went from falling to $2.5 trillion to rising to $2.71 trillion, but later corrected to the $2.65 trillion area. The recovery momentum weakened near the previous consolidation zone, with the market still struggling to break above the descending resistance line that has held since the U.S. presidential inauguration day peak. The sentiment index is gradually moving out of the extreme fear zone and consolidating in the fear area. This is a good signal that the correction may be over, but there are still not enough catalysts for a full-fledged rally. Bitcoin continues to trade within a relatively narrow range of $83,000 to $86,000, hovering around the 50-day moving average, but still struggling to break above the 200-day. On the daily chart, the RSI is showing a bullish divergence, with a higher low on the indicator despite a lower local price low. The following economic data events are worth paying attention to in the new week. Wednesday will see the release of preliminary PMI estimates for April, which could have a noticeable impact on sentiment on the euro and European equities. A strong recovery in business activity began in December, but could be shattered by tariff fears, as was the case with the ZEW reading for Germany in the outgoing week. On Thursday, an important piece of the economic puzzle could be the U.S. durable goods orders figures. They have been rising in the previous 2 months and may accelerate in March, but traders will be looking for signs of a possible peak in the indicator in the near term. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.